Welcome back to ETF.com, the video edition. My name is Dave Nottig. I'm the managing director here at ETF.com. Had another really interesting question today in today's live chat, which was, what do you do about tax loss harvesting? And really the question was very specific. If I own SPY, the S&P 500 SPDR from State Street, can I sell that at the end of the year, sort of book a loss on it if you happen to be carrying a loss, and then use that loss to offset gains, but replace my exposure with, say, VOO, which would be Vanguard's S&P 500 ETF? It seems like a really smart idea. It seems like a really interesting way to take a loss and turn it into something you can use usefully, offsetting some gains you might have somewhere else in your portfolio. There's a problem with this, though. The conventional wisdom here, and some of this is backed by various tax cases that have come up over the years, is that you have to do something more than just move from one index fund to another index fund tracking the same index. You have to have some meaningful difference in your exposure. And that phrase, meaningful difference, is where it starts getting a little bit tricky. So for example, most folks would suggest, most accountants would tell you that if you went from, say, SPY into a generic large cap index, the Russell 1000, something like that, well, there you're actually getting quite a different portfolio. And while you'll get pretty similar exposure over time, in any given short-term window, you could actually get quite different results from the Russell 1000 and the S&P 500. Similarly, if you just took the S&P 500 and did something to it, say you went into a minimum volatility version of the S&P 500, or say a value version of the S&P 500, those, I think any reasonable person would agree, are different exposures. They're still large cap US exposure, but they're different enough that I don't think the IRS is going to show up at your doorstep. And that's where I have to put the last caveat here. If you're really thinking about doing something meaningful like this, taking a big position and taking the loss on it, swapping it in with other exposure, you want to be very sure that this is going to pass muster should the IRS decide to audit you. So when anybody starts talking to me about tax loss harvesting and wash sales, really the first question should be, how well do you know your accountant? Because this isn't the kind of thing I think most investors are going to want to handle on their own. They're going to need some professional advice. So really two answers here. The short answer, no, you can't just swap for another index fund tracking the same index. Everybody pretty much knows that's not going to pass. The longer, perhaps more boring answer is, once you start looking at big changes to your portfolio like this that can have real significant tax implications, it's time to pull in the professionals, time to call that CPA. Thanks for listening. See you next time.